Hi everyone, it's Gordon again. This recording very much follows on from an earlier recording I did when I compared business structures, basically comparing a sole trade with operating as a company. And at the end of that recording, I left a couple of hanging questions. One of them was, if you operate as a company, how should you take your money out of the company? And this is what this recording now looks at. Now, just as a reminder from the previous recording, but a very important thing to remember, everything that I'm going to cover in this recording is not relevant to a sole trader. With a sole trade, you make profits, they're taxed as soon as the profits are made, both income tax and national insurance. You'll take your profits out of the company by taking drawings, and drawings have no tax impact at all. So, no decision to be made with a sole trader. You can take whatever you like, whenever you like. It has no impact on your tax position. However, if you have operated as a company, then things are different. How you choose to take your money out of the company makes a very big difference to your tax position. So what options have you got? Well, for most people, it's really the top two. You can take a salary or a bonus, same thing. Wage, same thing, or you can take a dividend. Now, in principle, they're different things. Your salary is a reward for work done. Dividend is what you take out as an investor in the company. But if it's your company, you own 100% of the shares, you can choose how you take your money out. Now, depending on circumstances, there may be other options. You may be able to put money into your pension. Now, that is incredibly tax efficient, but the problem is you can't touch the money until you're fairly old. And if you're only young, then pension contributions may not be terribly attractive. Now, just sort of looking in outline at our options, if you take a salary, you'll pay income tax on it at the main rates of income tax. There'll also be national insurance payable by you and the company, although that does depend on the level of salary, of which more later. But any salary paid is going to reduce the corporation tax payable by the company. Dividends, lower rate of income tax, no national insurance, but no corporation tax deduction. And also do remember, particularly relevant to a startup, you can't take dividends until you've made a profit. So if you've got a business plan where you're looking at losing money in the first year or two while you build the business up, you can't take dividends during that period. Now, the next two, rent and interest, are only sort of relevant in specific circumstances. Rent, if you own a property that the company is using, then you can rent the property to the company. Interest, if you have lent to your company money, and you can charge interest. They both have a similar tax impact. One that's always worth looking at, though, is benefits. If you can take the right benefits from your company, some benefits are either exempt or have a low tax charge associated with taking them. If they're exempt, there's no national insurance. And the cost of the benefits, being staff welfare, will be corporation tax deductible for the company. So what sort of benefits are we looking at? Well, common ones would be trivial benefits. Your flowers, your chocolates for birthdays, Christmas, for you and your spouse, if your spouse also works for the company, and your company mobile that you can use privately, as long as it's a company mobile paid for by the company, an exempt benefit, but because it's staff welfare, the cost is deductible for your company. And not exempt, but pretty tax efficient, the electric car. If you're thinking of buying an electric car, if your company buys it, 100% first year allowance means the cost is fully tax deductible for the company, which will save corporation tax potentially for many years. And although it is a taxable benefit, it's at a pretty low rate, so it can be very tax efficient. But what I'm going to focus on for the rest of this recording is the top two, the comparison of taking a salary or taking dividends. So, just to put some numbers on it, I'm going to assume that you've got a company making profits before your remuneration of 90 grand. And Just as a base, what I'm first of all going to do is have a look at the position if you take all of the money out as a salary. Now, you're going to have to work out how much salary you can take, because remember that 90,000 has got to cover your salary and the secondary class 1 national insurance on the salary. So to work out the amount of salary that will use up all the 90 grand, we need a little bit of algebra. Nice little formula. The salary, I've called G, and then the secondary class 1 will be 13.8% of G minus the secondary threshold, 9,100, and the salary plus the NI have got to come to 90 grand. After that, it's basic maths, and you get to a salary of 81.90. The secondary class 1 will be the remaining 8810, which will use up all of the 90,000. Well, that therefore means that the corporation tax is 0, because the salary and the employer's NI are corporation tax deductible, no taxable profit, no corporation tax. You are, though, going to suffer primary class 1, so that will be 12% on the profits from the primary threshold up to the upper earnings limit, 2% on the profits above the upper earnings limit, and I got that 5122.
You're also going to suffer income tax.
Take off your personal allowance, work out tax at 20-40%, easy enough to do, and you get an income tax bill of 19,508. But the thing that you're interested in is how much
can you spend, and what you've got left to
spend is your gross salary, less the primary class 1, less the income tax. So that leaves you
with a little over £55,000 available to spend, with all of the money taken out of the company. The question then is, can you do better? And the answer is yes. Now, how do you do better? Well, let's take an alternative approach. Let's assume we take a low salary. Now, I've pitched it here initially at 9,100 because that is the secondary threshold.
So, with a salary of 9,100, there'll be no national insurance at all to worry about. So then, to make it sort of a fair comparison, I then said, let's imagine we take the rest of the profits out as dividends. Now, I know in many situations you might not want to take all the profits out as dividends, but I just wanted to make it a reasonable comparative. Now, there'll be no national insurance because you pitched the salary at just such a level that there is no NIC. Corporation tax, you've got taxable total profit of the 90 less the salary, 8,900. That actually gets you into that wonderful marginal relief band, because I'm looking at tax year 23-24 in corporation tax terms, financial year 23. So you tax at 25%, you take off your marginal relief, and you've got corporation tax payable of 17,688. Assuming
you're going to take all the
rest of the profit out as dividends, the dividend
is then going to be
your taxable total profit minus the corporation tax, 63,212.
And so now we have a look at the income tax position.
You've got a salary
of 9,100, a dividend 63,212. Take off your personal allowance, brings the salary to 0. You've got a bigger personal allowance left for your dividend. And tax year 23-24, your dividend nil rate band is 1,000. And in subsequent years, that's going to drop to 500, which will mean the tax bill goes up by another 44 quid. Rest of the basic rate band dividends 8.75, then the rest of the dividends 33.75. So you end up with an income tax bill 10,639. How much money have you got left to spend? Well, you've got your salary plus your dividends minus your income tax. Remember, no national insurance because there's no NI on dividends, and you pitched your salary at such a level that there is no NI. And that gives you net spendable income 61,673. Compare that to taking everything as salary, and you're over £6 grand better off. That's quite a difference. So it shows the importance of getting this right. Now, having looked at that, you might think, well, can you do better again? Actually, you can. What you can do is just tweak what I've just done. Rather than taking a 9,100 salary, take a personal allowance salary, a 12,570 salary. Now, if you do that, it does mean there'll be a little bit of secondary class 1 to pay. The company will have to pay 479 quid of secondary class 1. Then when you pay your corporation tax, there's going to be a saving because you've got a slightly bigger salary. You've also got the secondary class 1 that the company will pay. Again, you're still in the marginal relief band. So your corporation tax comes down a bit, 16,642. Your dividend is now a little bit lower. So I'm just going to repeat the calculation from previously, but now we've got a salary that uses all the personal allowance up. All of your dividend is taxable. Again, I'm doing my calculation based on tax year 23-24, so you've got a 1,000 dividend nil rate band. Rest of the basic rate band 8.75%, the rest of the dividends at higher rate. Now, when you do that and you now recalculate your net spendable income, salary plus dividends less income tax, you've now nudged it just above 62,000. So it's an improvement of 364 quid over the 9,100 salary. However, you do now need to operate payroll because you're paying a salary subject to the secondary class 1 NI. So you've got the hassle of having to deal with the national insurance and payroll. So even though this does save 364 quid, many people would go for the lower admin route and just take the 9,100 salary.